Yeah, it's doing terrifically well. Again, that unlike ActiveOps, the earnings multiple looks quite rich, but nowhere near as rich as ActiveOps. But it's trading at about 30 times forecast earnings, which in isolation looks quite full, but not if you consider those earnings are forecast to rise by 40 odd percent. So its price earnings to growth ratio is about 0.6, which is actually pretty encouraging.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started.
Hello, Chris. Good to see you again.
Hello, Lee. Nice to be here. Big week for the UK with the election.
Yeah, politics though. Should we avoid that conversation?
Yeah, off the agenda. I think there'll be a lot to talk about over the next few months. So yeah. And its influence on stock markets or not, and interest rates and everything. Yeah, it'll be interesting time.
It's going to be very interesting, isn't it? What we're going to look at this week then. So we're going to discuss the article that's just been published on Investors Champion about AI, artificial intelligence. Huge topic, isn't it, Chris? It's just everywhere.
Massive. And you can't ignore it if you're interested in the stock market.
But then AI does have its consequences, doesn't it? As we're going to discuss with Google, the environmental impact. And then we're going to come on to the small caps. We've got System1 coming up next, then Craneware, ActiveOps, and finish off with James Latham.
Yeah, I just think there's fantastic value in small caps and AIM. Clearly, we're a specialist as in fundamental asset management, the investment management firm in small caps and AIM. There's great value to be picked up by perhaps maybe braver investors at the moment. Clearly, there hasn't been a lot of money in small caps and everybody's happy with their money in the bank. But come on, if you're thinking of investing small caps now, there hasn't been a better time current for a long time, in our opinion.
Yeah, and that's the reason why we wanted to lead with System1, because that kind of highlights exactly what you've just said there, which you've identified as been doing really well.
Yeah, I think it's been doing fabulously. It came on the stock market in 2006 with a brilliant name of Brain Juicer. What a great name, Brain Juicer. And it changed that name to System1 in 2017, which is not as interesting, really. System1. But its fortunes have changed, and it predicts and improves marketing effectiveness. So it can assess the emotional response to ads, which is then clearly good for advertisers and their customers. And so it can do ad testing and subsequently can provide consulting service to help advertisers improve their emotional response of their ads. And its revenue is absolutely flying. It's pushed ahead with this so-called platform. And revenue in the year to March rose 28% to 30 million. Pre-tax profits were up even more to 3.1 million, 33%. But it's not just that. Forecasts are now predicting high double-digit growth for next year and the year after. And it's doing terrifically well. Again, that unlike ActiveOps, the earnings multiple looks quite rich, but nowhere near as rich as ActiveOps. But it's trading at about 30 times forecast earnings, which in isolation looks quite full, but not if you consider those earnings are forecast to rise by 40 odd percent. Its price earnings to growth ratio is about 0.6, which is actually pretty encouraging. The share price has leapt beyond even the house broker's forecast, which is probably less promising, because house broker forecast target prices are generally quite generous, but its shares have risen to such an extent, I think circa 3 times over the last 12 months, which has been fabulous. Yeah, good to see it working, although I'd have preferred the old name of Brain Juicer.
Is that one that you own in any of the fundamental portfolios?
We don't know. It was too small, and yeah, I regret it a bit. We missed out on that one. But who's to say it can't go on to greater things? Worth looking at all of these stocks still, ActiveOps and System1. Just because the share of a very small company has risen 3 times, it could get a lot bigger. This business is still only a sub £100 million company. And if its offering is as good as it would appear to be and as interesting in quite a decent market, but it could be 10 times the size and still be quite a small company in the grand scheme of things. So, yeah, worth following.
Perfect. And we'll touch on a couple more software companies later on in the podcast, one of which Fundamental is invested in and has been invested in for a long time. But we're going to bring it back to some of the companies at the other end of the scale. and that's around artificial intelligence. And some may say that the valuations are in bubble territory, Chris, and some of these tech companies perhaps are looking a little rich. But what's your thoughts on that then?
Clearly, that's part of the article that we published. Our tech guru published his thoughts. And yeah, when you look at Nvidia's market cap is now $3.2 trillion. That's just crazy, isn't it? Bear in mind, though, that people were calling Nvidia overvalued only a year or so ago when its market capitalization was $1 trillion. Now it's 3 times the amount. But yeah, bubble, everything's about AI. Every stock market release you listen to from companies that are remotely connected to this space or using AI, mentions AI and tries to project their potential with AI-related products. And yeah, it's been a key driver of the stock market, whether it's Nvidia, whether it's Microsoft, whether it's Alphabet, Meta. But yeah, it's just all encompassing, isn't it? This AI boom that conceivably is still at an early stage. We're really just at the start of it. But yeah, is it a bubble? Perhaps some valuations become inflated and the likes of Nvidia have got to keep delivering to justify this kind of valuation. They're going to have to keep delivering for many years. Fantastic growth and demonstrate that they are the kings of the AI space. And when a market is so big, that typically attracts competition. And sure enough, I'm sure others will start to play catch up. Even their customers at the moment, as we've mentioned before, are investing in their own AI chips. The likes of Apple, Microsoft, Alphabet, they're all making their own investments, Meta in this space, but you can't ignore it. And a lot of people think they can ignore the latest trends, the latest technology, but that's just rubbish. You can't ignore it. It's been a stock market driver. It's been driving the US market, which in turn drives all stock markets. So ignore it at your peril. But yes, perhaps there is a bubble there building for sure.
Let's say you're looking at, you've sat on the sidelines. What's the best steps of how to enter this space then? How would you?
Our view has always been, and our firm view is to take a position in the biggest. You can try and spot the smaller players, but have a piece of the Microsofts, Alphabets. They've got such vast resources, such huge amounts of cash that they're surely going to be the winners in the space. Yet, yes, they have other parts of their business, so you're not going to get a really big bang for your buck as you would do, say, in a small cap stock that's suddenly got a very nifty position in AI. But if you want a piece of it, you want exposure to it, we always think to follow the market leaders, which big tech has been. And there have been other smaller players. A company comes to mind like Supermicro. That was a big winner from it. I haven't followed the share price recently, but that's in the mid-cap space. That might be one that braver investors might be interested as well. But our view is to follow the giants, really.
And do you think someone like Robinhood, who's just made the acquisition for Pluto Capital, do you think that they're trying to get in on this AI space?
I thought this was interesting, Robinhood. First of all, I didn't realize how big it was. Robinhood is a retail investor platform in the United States, largely in the US. It's come to the UK now in Europe, and it's valued at $20 billion, which is about 3 times larger than Hargreaves Lansdown, which is currently been subjected to a takeover approach from private equity and others. But yeah, so Robinhood's huge. It's captured a lot of retail traders in the United States, which is a big trading market. But it's bought this AI-powered investment platform called Pluto, and they didn't mention what price it's paid. But I like the excuse. These models can process and interpret real-time personal and global financial data. These are Pluto's models, enabling, wait for it, quicker identification of trends and opportunities in the market. To my mind, all this is trying to do is encourage you yet more active manic trading through Robinhood, which of course benefits Robinhood. It's a way, it's a covert way of helping drive their trading revenue. If you're into short-term trading, which we aren't, fine, maybe a benefit. But I can see the ulterior motive to this is to really help supercharge your people trading through Robinhood, which is what their game is all about.
And then what ends up driving the trends? Is it AI or is it the individuals buying and selling? Who's leading
circle,
who?
Isn't it?
Yeah.
It's a beautiful thing. So you've got AI driving everything, and it's just crazy. But
yeah,
I'm not entirely convinced. But again, they're making a move. They're deploying a lot of money into it. They're making a move in crypto as well, in the European crypto market. This is a second acquisition in the space of a month. So it's a big thing. Everybody's trying to get a piece of this AI cake, and it remains to be seen who the winners are going to be.
Has the AI cropped up in the fund manager space as a conversation? Is anyone in the fund manager space concerned about AI?
Oh, I think they all are. I mean, they've been
Yeah.
concerned about passive investing for a start. And if there's something here that's going to simply supercharge that, it's not great for active fund managers. We're in a world now of an investment world where people love active funds because they're very cheap, they're low cost, they simply track indices. You don't need to have a highly paid investment team. You just need a computer model running it. And now if you've got a computer model that is in turn being AI driven, your costs are probably going to fall further. So yeah, I would say it's a real threat to large cap fund managers. Don't think it's as relevant in the small cap, micro cap space because there's not as much liquidity there. Disappointingly, nobody's been interested in small caps for a while. But yeah, I think it's affecting everybody.
So we've just spoke relatively positively on the whole space there, including the tech companies. But what's the downside risk? There's always a downside risk. Is the energy demand side of it going to have an impact on these companies, Google, Apple, Amazon, etc.? The energy required to run these AI processing centers is becoming a big factor, isn't it?
Yeah, it is. Yeah. Google carbon emissions are up 50% since 2019. And this is for a business that's trying to get to carbon neutral. It's pretty shocking that for a business that had viewed objectives is now really coming up against this barrier, this energy use for its data centers, many of which are being used to support its AI ambitions. And we've heard the likes of Amazon Web Services striking deals with the nuclear power generators, energy deals to supply electricity, hopefully lower cost. The whole nature of big tech is changing. These big tech companies were very capital light. They didn't need to invest much in capital. It was mostly about people capital. They didn't need lots of buildings and lots of hard assets. All of a sudden, what are they doing? They're spending an absolute fortune on data centers and chips from the benefiting the likes of Nvidia. Also now they're huge consumers of energy. So that the nature of their businesses are changing dramatically. And we may not see the tremendous returns on capital that they've been generating for all these years. These businesses are really evolving in not necessarily the best way from an investment perspective and also an environmental perspective.
Does that concern you in terms of the long-term potential growth? Do you think long-term, because of that shift, we might not see the returns we've had from these major tech companies?
Yeah, it's not easy, is it? You've had success in one area, which has demanded relatively small amounts of capital, and now you're being forced into another area to keep up with your peers. And are you necessarily going to be the winner there? It's not unique. Google had its dominance in search, Microsoft in operating system and productivity solutions, and suddenly they're all in the same boat. They're all lumped together into the AI piece, and they're all fighting for that same bit. I don't think it's ideal, and they're all consuming vast amounts of energy, and then they're playing catch up. And they're going to consume even more amounts of energy, which again isn't great. So I think the investment appeal in terms of the future returns, there is a risk there. Can't ignore it, but be careful. Be rational. Maybe prepared to take some money off the table. Don't necessarily follow everybody blindly. Think rationally about how things are developing.
Shall we move on now then to our next topic, which is a little bit around, well, hopefully, common sense investing. And it's just about noticing those trends around footwear and the companies that supply our shoes, Nike, Asics, and Birkenstocks. Nike, which was part of the Investors Champion Ultimate Stocks portfolio, which you exited in February, just before the 20% drop we've just seen.
Yeah, it's tumbled even more. It wasn't a great performer before then. But yeah, as you say, I think this is the obvious and how anybody can assess a trend of where things are going and how a market is evolving. And really, the penny didn't drop for us. It should have dropped well before it did, but we've got there before the recent drop. But yeah, it hasn't been great for Nike. And I think anybody that looks around and sees what people are wearing on their feet could have seen that this market is now full of all sorts of nimbler, more innovative new entrants who are doing extremely well. And unlike Nike, previously this was Nike versus Adidas, or it's now Nike, Adidas, On, Hoka, Saucony, Puma, New Balance. There are so many brands in this space, and some of them are doing really well. Nike's still a giant, but there are so many other brands that have been taking a little bit of the pie. And it's hard to see how Nike can come back from here, really. Can it become dominant again? I'm not so sure. We've moved on. I don't know what you think about it.
Yeah, I mean, I would agree that you don't see Nike shoes or Nike even attire in the same sort of vein as you did 20 years ago.
Yeah.
As you correctly pointed out, it was Nike, Adidas, Reebok. And I think we probably can thank the internet for that. Instagram, influencers. I think that sort of area has had such a big impact on all these new entrants to the market. And not just in footwear, but in clothing as well, like Gymshark. Could you
Yeah. I don't know. We're privately owned, private
yeah,
equity
still
backed,
privately
isn't it now?
owned.
Yeah.
Yeah. Can you imagine a company like that succeeding pre-internet?
No, you're right. You're right. So yeah, that's exactly the point. All of these businesses got to market very quickly.
Yeah.
They didn't need huge distribution. Clearly,
It's the
Nike and
distribution
Adidas.
channels, isn't
Yeah.
it?
Nike and Adidas have the distribution, but these other brands were able to break into this market without the great distribution. It was still relatively small, but they've absolutely taken off. I think what's also interesting is the running community, I think, a lot of them kept very close to the runners, On and Hoka, and they kept really close to the running community. And I think maybe Nike it seems to have distanced itself a bit more. Nike was always about backing a big personality as well, backing a big sport, starting with Michael Jordan, Tiger Woods, and Roger Federer. Now, Roger Federer, he's got an equity stake of circa, I think, 3% equity stake in On Holding, a Swiss company.
Yeah.
Founded in Switzerland, listed on the US stock market as well. And On Holding shares have been going great guns. Been absolutely flying. And Roger Federer's got his own shoe there, and he's been helping them with design. So I just think it's a really interesting dynamic. And anybody could have seen this happening. You didn't need to be an investor. Probably better that you weren't, because you could have seen what was happening in this market, I believe.
And a company as well that we were just discussing before the call, which I've seen popping up in a lot of popularity lately, is Birkenstock sandals, founded in 1775. IPO'd in 2023, $45 circa. Now sits at $56. UBS has just upgraded them with a price target of $85. And I'm hearing just people talking about them, people wearing them, buying them.
I think it's amazing that a brand that was never viewed as on trend or whatever is suddenly super popular with everybody. And I just find it so ironic that was probably a really old-fashioned brand is suddenly taking off. Again, it's the trend for wearing casual footwear. We're not clamped into stiff leather shoes anymore, and we're wearing things that are comfortable. People are working at home more. They don't need to wear the uncomfortable leather shoes. And this is all part of it, I think. And again, as you said, it's so easy to see. You're seeing friends who have several pairs. It's obvious.
I've got a friend who's got 3 pairs. Loves them.
Wow.
I think circa $100 each or something like that.
I don't know. I just think it's incredible. The irony as well is, and Nike's been suffering. The origins of Nike were actually with Asics, and they were which is a Japanese company. And Nike began its business in the 60s, importing and distributing Asics shoes. It wasn't known as Asics then. It was a Onitsuka or something. The Onitsuka Tiger. But Asics as well, the Japanese listed company, its shares have, I think, doubled over the past year, been doing terrifically well, which probably really greats Nike as well.
Since Asics joined the stock market, the share price has risen just short of 700%.
Wow.
And it was down in 2020 around $225. It's now up in a region of plus 2,400.
Really incredible, huge success. Again, you could have probably seen it. My daughters all been wearing Asics for ages. That was their shoe of choice, running shoe of choice. So again, it's pretty anecdotal maybe, but pretty obvious to see if you could have dug a little further, had a look at Asics then, it was in front of you, looked at its stock market price, share price, looked at its valuation, seen how well the momentum was, what it was doing, and you could have made a decent return on that stock. And there's no AI in that. This was just common sense investing right in front of your eyes.
Yeah, and I think the Asics story, look, they're 35 times forward earnings now, so maybe they're a bit rich now. But back in 2019, early 2020, you stood there on the running line for the marathon or for the race in your local area, and you're just looking around and seeing what people are wearing.
Yeah.
And if the majority are wearing Asics shoes, it's like, oh, right, okay.
They're doing all right. People
Yeah,
must
they're
like
doing
this
all right.
lot.
And equally, Birkenstock, just start to look around if people are wearing these lovely looking sandals.
When you've got a consumer facing good like that, it's so easy, and people often miss it. and it is there for everyone to see. And that's what common sense investing is all about. And you can read books by the great Peter Lynch, One Up on Wall Street. And I think he mentioned a story when his wife came back to him when he sought her opinion on some product that was for sale in the stores there. And it was as obvious that the shopper or the consumer can see things faster than often the investor cocooned in their glass tower.
Shall we move on to the UK small cap space now? Starting off with Shoezone to continue the shoe
Yeah,
theme.
I thought it'd be worth considering the shoe theme, but here is a business that has been offered a bit of a roller coaster ride to holders over recent months. It's recovered well, and subsequently had a series of profit warnings. And the latest one, there were all sorts of excuses, cost pressures associated with high container prices, shipping rates because of the problems rerouting away from the Suez Canal. They also mentioned weaker spring-summer sales. That was due to unseasonal weather as well. So we have all these things, and Shoezone's come out with another warning. It's a warning after a previous warning, and its forecasts have been cut materially. And we just wonder, Shoezone's in the value space, and we just wonder if it also that there's more to this than meets the eye. Is it business really? Are its activities being affected by the likes of some of the lower cost retailers likes of Shein and H&M and other competitors? Is life tough? It's not just about those excuses that it's introduced.
It's probably struggling given its high street as well. I don't think it's got much of a brand presence online, has it? I don't think it has.
It's tried to grow online, but it's evolved as well from smaller high streets to so-called bigger box stores off high street in commercial parks. That seemed to be going okay, but yeah, it wasn't a great announcement. And as you say, there's no brand appeal, there's no innovation in it. There's nothing like those footwear running shoe companies that we mentioned, sports shoe companies. It's polar opposite to that. It's cheap and cheerful. Yeah, not an easy space to be. And it's been one for the traders. They've done all right out of it, but now the shares have tumbled again.
Yeah, we can move on to Craneware, market leader in value cycle solutions for the US in the healthcare market.
Yeah, this is a great little business. We've held Craneware shares for a long time on our AIM portfolios. That's we as in fundamental. Its growth has struggled a bit of late. It's moved its software operations to the cloud. It was a bit late to move to the cloud. It's a UK company that's based in Scotland, but actually it only supports the US hospital sector. But it's got this new collaboration with Microsoft, which sounds quite nifty. The thing with Craneware is it's collected an awful lot of data over the years. So there's nearly 200 million unique patient encounters. So there's a lot of data, and this could be a big AI play as well. You can start meaningfully crunching that data, what kind of trends you can assess, and especially in the healthcare sector. This could be good news for Craneware. And so worth following it. We remain happy holders, although it has tested our patience a lot over recent years.
What is it that the software actually do then? It says
It
here
tracks all the costings through. So if you go into a US hospital and have treatment, it monitors all the costs you're subjected to through that process, and then the billing and the payment process through to like the Medicare, Medicaid, or your insurance company. It's monitoring that the whole way and supporting the justification of it and the billing of it.
a software company then that supports the healthcare. You're probably aware that US healthcare payment system is a minefield as well. So
that's it. And minefield creates opportunity.
It does,
and especially one where it's got to demonstrate value, because at the end of the ticket, you've got a big insurer who wants to make sure it's paying up for what it should.
Agreed. And the next company then in the small cap space, ActiveOps, a member of class of 21.
Yeah, I call it the class of 21 because this was 2021 was the year we had a huge number of listings at the peak of the market, of small cap market, ironically over a pandemic, when things came to the market at ridiculous valuations and everybody paid up too much for them. And ActiveOps is one of those. I don't know that much about it, but I just thought it was interesting. It had results this week. It's a provider of a so-called decision intelligence software for service operations. It helps efficiency in service businesses. A lot of its customers are in the banking, insurance, healthcare administration. But yeah, the shares having soared, subsequently tumbled, but it seems to be doing okay. Revenue's still up, decent cash generator. But what got me, it just reminded me of this 2021 when everything listed in the private equity backers and also a lot of the founding shareholders, they sold out a huge amount of shares at the top of the market. They took 70 odd million pounds off the table. The guys backing this were totally bonkers in our opinion. When people back these listings, when people are exiting to such an extent at such a stratospheric valuation, valuation at the time was 120 million quid, and it had never made any money whatsoever. It's just announced a maiden pre-tax profit of $1 million. We were paying up for this business 120 million, and it's only just made $1 million. At least it's starting to deliver, shall we say. It's not a total failure like so many other companies were. And their shares soared originally, but then they were cut in half. It does seem to have something that's interesting, at least. It's got some seemingly interesting software offering that would be worth finding out about a little bit more. But yeah, bonkers.
Yeah. Not a bonkers bargain, though.
Not in our opinion. It's not a bonkers bargain. Not at the moment. Even at the current level now, it's on a P rating. It looks pretty rich. 100 times forecast earnings. Cash flow looks a bit different. It's a bit more modestly valued if you look at the cash flow. But yeah, you've got to, I think the P ratio doesn't mean much in that. And hopefully we'll see start to see an acceleration of earnings. If it's developed its software, it's all about now marketing and rolling it out. So development costs will fall, and the distribution marketing element may rise. But yeah, interesting businesses which has got a nice load of cash, and hopefully it will go on to justify its valuation.
Yeah, brilliant. And we're going to finish off with a company that you're a fan of. Simple is often the best, as they say, though. And James Latham. Good results and a special dividend.
I thought this was good to finish with this business because it's the polar opposite of anything AI related.
Pretty much everything we've just discussed, isn't it?
Yeah, it is. Yeah, James Latham is a timber distributor. It began importing hardwoods into Liverpool in 1757. So it's been around a while, and its reporting is also always beautifully clean. No adjustments, lovely reporting, and it clearly benefited hugely over the pandemic. When the cost of materials went through the roof, James Latham benefited because it was priced up. It's cost plus kind of thing. And it did really well. Clearly, those extraordinary times are over, and these were more ordinary profits, but it was still, revenue fell back 10% in its last financial year, and profit before tax fell 32%. So you saw a decline. However, cash has continued to grow. This business is really conservative. We're always impressed how it can squeeze more and more out of its warehouses. You get the story that it's putting in more racking. I'm staggered how much racking they can keep putting into these places to drive greater revenue from them. But free cash flow was absolutely been terrific, and cash has been growing. And what are they doing? As they've done for year after year, is they're rewarding their shareholders with yet another big increase in the final dividend, 20% increase in the final dividend. So you've got a business where returns have been reduced, where profits are down, but they're giving even more back, 20%. And they're not only doing that, they're paying another special dividend as well. And we worked out that over the past decade, shareholders will have received aggregate dividends of 273 pence, and that's equivalent to 22% of the current share price over the last 10 years. That's pretty attractive. So you've had share price growth, some great returns, a rising dividend, and squeaky clean results that anybody can follow. Can one ask for more from a boring old timber distributor? Sorry, James Latham management, but clearly there's more excitement around the timber distribution.
Yeah, quite interesting to finish off with such a company, contrasting the software companies that we've just discussed, the AI companies at the beginning. It really just shows that there's something out there for everyone, isn't there?
There is, and sometimes the most obvious are right under your nose. Yeah. And actually, James Latham's headquarters is not a million miles from our offices. Right. I visited them many years ago, and we've held them in our AIM portfolios for a long time. And sometimes the shares haven't moved very far, but we've always had a dividend. But you look back over a decade of the share price return, it's been pretty good. You could align it with many jazzy retail stories or software companies, and James Latham would have outperformed. His total return would have been better than all of them.
Yeah. Is the family still heavily involved?
Yeah, you've got a big family involvement still in the business.
Hence family running special dividends, probably.
Yeah, the family members probably like it.
Yeah.
And it's just a cracking little business that does what in its relatively, should we say, mundane sector, it does really well, which is what you should be looking for.
I think hopefully in this episode, we've touched on something for everyone. I think with discussing the shoe brands, Nike, Asics, and Birkenstock, for the more general investor just out there looking at trends, we've gone into the more detailed System1, and we've touched on AI, and then now we've finished off with a very simple company that produces good returns and clean reporting. So I think this has actually been quite
Yeah, it has, hasn't it? It's been quite a ride, this one.
I think this one's been really quite broad, but quite interesting, and hopefully the audience has enjoyed it as much as I have.
And I can't see timber going out of fashion, really, of the sort that it provides.
Not.
It does even distribute some other products as well. It's got a lot of its own branded stuff. So, yeah, it's a great little business.
Should we leave it there then?
Yep, sounds good.
Brilliant. Thanks, Chris.
Thanks very much.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.